Hello everyone, this is Victor Riesco, CMT. I'm doing a market update for June 9th, 2025, and I'm doing this video before the market open of Monday. And so let's go ahead and see some charts. We're going to start with market trends, and my signals are unchanged from last week. Um, Basically, everything is in a long-term and short-term uptrend except for the long-term trend of the Russell 2000 and high yield bonds, which I'm using J and K as a proxy. Let's start analyzing the Russell 2000, which had a very strong week last week. And as you can see, it's still trading below a declining 200-day moving average. It's still sloping down. But looking at the chart, it seems it has completed a inverse head and shoulders pattern, which has bullish implications. And this has been the lagging index for quite a while, but it had a strong week despite yields actually moving higher last week, and some turbulence with the president and Elon Musk and whatnot. But it's showing strength, and I'm doing this video pre-market, and it's gaining almost 1% before the market opened. So we're seeing some rotation into the Russell 2000, and it might be it's time to shine. But still, it'll take a while before the long term turns bullish once again. We probably might see something like a rally until this area of congestion of previous support, and then maybe a slight pullback back to the 200-day moving average, and then the start of a more continued uptrend like we saw back here. We'll see. Other than that, everything is bullish and basically unchanged from last week. Something that caught my eye that is Bitcoin. I'm using IBIT as the proxy, or we can just look at the chart from Bitcoin itself. But we see that it had a breakdown below 103, and it quickly recovered it, and now it's gaining over 2% today and back to 107. So Bitcoin also has been in a long-term uptrend and actually held very well despite all the turmoil of the Trump tariffs and such. It held basically maintained a rising 200-day moving average, and now with this breakdown, below 105, 103, which were support or previous highs levels. Now we quickly recover them, and that's a false breakdown, and it usually is a very bullish pattern. So it is likely that we'll maybe push to new highs on the coming sessions. So all in all, trends look very favorable, long term and short term, and it's likely that this market, which is just a tad below record highs, will test these record highs and probably go for higher highs in the coming weeks or months, because everything at the moment looks very bullish. Let's see market breadth. Market breadth also, it's positive in all time frames, long, mid-term, and short-term. For all these signals flipped bullish during the month of May after that, very sharp correction we had on March, April. And if we look at the charts, we see that this is a long-term breadth. We see that the green is over the red. That basically it's more buying pressure than selling pressure in the long term, and clearly buying pressure is dominating, and actually it's making a new high compared to the one we had on the previous highs on December. And here we saw this negative divergence in the highs we reached February. Now that we're seeing a positive divergence, that we're not at new highs, but the breadth is making relative new highs compared to the high we saw here back in December. So that's also bullish. Midterm breadth also a bit weaker than the longer term breadth measures, but also we see that more green than red. That means buying pressure is dominating, which remains in positive territory. And short-term breadth, which can be more volatile, it's still clearly on positive territory, and we had a slight dip into negative territory just a few weeks ago when the market did this very shallow correction to its 200-day moving average. But we quickly recovered this and started moving higher. So nothing to worry about here at the moment. We could worry if this gets overbought, then we might see some exhaustion on the rally, but I'm not seeing anything particularly worrisome. On the contrary, everything looks bullish. Looking at last week's action on individual sectors ranked by alpha, which is one way I measure. It's a combination of relative strength in different time frames plus accumulation, and also adjusted by the volatility of the sector. So gold is number one. Of course, it has it moves slower than ARC, for example, but gold adjusted by its volatility and and also accounting its accumulation, it's still the number one sector. But so we rank all sectors like that using that criteria. But basically, what we saw last week was a full risk on rotation. The week prior, defensive sectors had the biggest gains. So we saw some defensive rotation. This last week we saw very aggressive risk on rotation. For example, we see the biggest gainers are high beta stocks in 4% on the week, ARC Innovation 8%, communication sectors 2.28, Russell 2000 3%, Nasdaq 2%, technology 3%, growth stocks 2%, biotechnology 6%, semiconductors 5%, oil 6%, energy 2.3%. On average, between all of these sectors, the average gain was 1.9%. And look which sectors were negative. Consumer staples, negative 1.4%, low volatility, 0.7%, utilities, 0.89%. So all the defensive sectors actually declined or lagged, and the high risk, high beta sectors had big gains. So that's showing you the money is going into the riskier sides of the market. Clearly not something that's bearish. And also basically most of all these 33 sectors, 26 are outperforming consumer staples, which is the defensive sector. Also something you don't see if the market is bearish. So all in all, very bullish action across the board. And we also saw a revival of emerging markets and China, which had lagged a bit during the last few weeks. China, a very big gain of 4.5%, and emerging markets 3%. Also, Europe, large cap stocks still with a very nice 1.6%, which also has been a very strong sector that held very well during the April correction. So if something really bearish was about to hit the market, we would have probably seen defensive sectors keep on having bigger gains than aggressive sectors, and you would probably see a lot less sectors beating defensive sectors, which is not the case. And it's something that we observed during late February, March, that basically consumer staples were outperforming everything, and the bigger gains were in defensive sectors, and high risk sectors were actually performing pretty poorly. It's not the kind of action we're seeing right now. So all in all, bullish. And also something that it's bullish that is that the VIX, we had this giant spike back in the midst of the downturn, but we've been trading below 20 for some weeks. We had a small spike on that dip we had on stocks a couple of weeks ago, but it quickly faded and got back below 20, and it ended on Friday trading at 16.77. So a good kind of rule of thumb is if you're in a bullish environment is to see that the VIX is trading below 20 and below its 200-day moving average, which is the case right now. And if we see this study, which is by Sentiment Trader, very good webpage of technical analysis and sentiment studies, it's analyzing the growth of $10,000 invested in the S&P 500 based on the VIX condition. So basically, when the VIX is below 20, like it is right now, this is a study from 1986 to 2025. If you invested 10 grand back then and remain invested only when the VIX was below 20, your return would be 600%, a max drawdown of only minus 20.1%, and the max time it will take you to reach a new high in all this period will be 1,519 days. If you see when the VIX is above 20, and you would have been invested only when VIX is above 20, your return would be less than half, 287%. Your max drawdown, this is really important, increases threefold from minus 20 to minus 62%, which is a devastating loss. And also your max time to new high triples, from more than triples, from 1,500 days to 4,537 days. So we are clearly in a beneficial environment for taking risk, for looking to be long stocks, and of course, if this changes, we'll change our game plan, our view, but it's not the case. And also something that's interesting, and I got this chart from Jardine Research, also a very good webpage. It's the ratios of the bull and bear ratios of Investors Intelligence and the AAII survey. And if you look at the average in both charts, right now we're clearly way below the average, bullishness or bull bear ratio. Actually, there's more bears than bulls. So even though I was talking about these bullish technicals, bullish trends, bullish rotation, bullish breadth, VIX below 20, but investor sentiment is still, very fearful and not really trusting this rally. So in a contrarian perspective, this is something positive, and it suggests that this rally has more to go. And to end this video, I want to talk about some trade ideas that could be interesting this week. It's been hard to come up with some, nice risk-reward setups, because most of the most interesting stocks or setups have already run quite a bit. So, for example, Roblox, this was a very good setup right here, but now I think it's pretty extended. So, or other stocks like Groupon, you didn't get in on this after this consolidation. You basically missed it, and that's the case. Also, another stock I liked, Net, basically the same thing, big move higher, tight consolidation, another move higher. So it's been a bit tough to look for some good setups this week, but we'll see what we can do. One that I like is Philip Morris. This is from a defensive sector. It's not a fast moving stock, but it has shown a very consistent trend and outperformance and high relative strength and alpha. Also a lot of accumulation, and it's basically just pulling back, consolidating a bit here over 180, which is its all-time high, I think. So I would like to see this maybe this stock to clear these highs of 182.70, let's say, for a signal that momentum is back and that the stock will continue to climb. Another one, gold. It has been a little bit lagging as of late, because basically stocks have been performing well, but still has been holding its 21-day moving average, and right now it's with negative momentum, but still it's in a positive short-term uptrend and with a lot of accumulation. So I would like to see this one for momentum to come back to it. Maybe we could clear this level of which is the previous high here. It's feels 650, let's say. If we clear that level, it could be an indication that gold is back in play, and probably that would flip momentum to the upside. But also a very steady trender, and with all the still geopolitical noise and all the headline risk, I think gold still showing technicals and an environment that it could still perform well. Another stock that has been has performed pretty decently as of late is CrowdStrike. It recently released results and it's pulling back after results, and it held the 21-day moving average, and it's been basically climbing slightly higher since then. Still in a very in a area which is actionable. There's not, you can still take a trade here and not risk as much. Maybe just start to below the 21-day moving average. Momentum is back on the stock, also with a lot of accumulation. The short-term uptrend has basically held intact except for one day, which quickly reversed. So also you see a lot of outperformance before, I guess defensive sectors for quite a while. So this is one I also like. One sector that looks interesting is financials, which um, it has been showing some good accumulation. It's in a short-term uptrend with positive momentum. It's trying to, break out of this area here of over 50, 51.21, let's say. Um, it's held its 21-day moving average on the recent pullback, so it's a sector that looks okay to look for a trade this week. Also, one that has improved a lot as of late has been materials, which was consolidating here tightly below its 200 exponential moving average. It broke out last week over this area, and now it's consolidating a bit, just above the 200-day exponential moving average. You see that the 21-day moving average is moving higher and catching up to price. So it's a sector that has been lagging for quite a while, but now it's showing good accumulation as of late, and finally some positive alpha, and outperforms against staples. So it might play catch up to the rest of the market, and you have this target around 91 as the first target, which also was a support right here, and then we would probably move until these highs around 95, 95.30 and change. So that's the sector I'm watching for this week. And well, I mentioned Bitcoin earlier, and this is pre-market. This is the ETF IBIT. Now, as I mentioned before, we had this false breakdown below this area of support, below the 21-day moving average, which we quickly recovered. And now it's today pre-market, we're seeing that momentum is coming back to the stock and taking out all these previous highs of this recent consolidation. So it seems likely we'll move into this recent autumn highs, and then probably up to 65 in the next sessions. And also it's pretty actionable in the sense you're not taking a huge risk by entering now, and you can put a stop just below the 21-day moving average, give it some leeway, but looks pretty bullish. So that's it for now. I hope you like this video. If you like my material, my updates, click like, share them, and also you can follow me in X as Victor Riesco CMT. You'll find me like that if you search for me in X. So hope to hear from you. Hope to hear from some feedback, some things that maybe you want me to discuss. So that's it. Good trading. Good week.